questions about the approach of handling share buybacks? So how will you summarize the approach? Step number 1, calculate what? Do the shareholder analysis. Determine what was the shareholding before and what is the shareholding after. That is step number 1, right? Step number 2, prepare a legal analysis of equity. Why? In order to be able to determine the NCI before the transaction. What should be included, or what are the key calculations? You need the goodwill per shareholder. Don't worry about goodwill in total. Worry about goodwill per shareholder. The goodwill for the parent and the goodwill for what? For the NCI, right? Then after you get the NCI pre the transaction, process what is causing a change in holding. Is it a share buyback? Is it a new share issue? Is it a rights issue? Are we together? Whatever it is, add it to the latest NAV that you've got. And then split that new NAV based on the shareholder analysis that you've just done in your first calc. And allocate to the NCI. After you've allocated to the NCI based on the new shareholding, determine the goodwill. Is NCI increasing or is NCI decreasing? If NCI is increasing, they will sell a portion of what? They will sell a portion of their goodwill to the parent. So they will now be left with their new shareholding's goodwill over the old shareholding. Had they increased in terms of holding, then you will have said they have bought the parent's goodwill. So it will have been 1.1, which is theirs, plus the parent, which is 4.4. Multiply by what? Multiply by what they bought from the parent over the parent's old shareholding. I would get that would be their new goodwill if they've bought up. They've came from 20 to 25, for instance. Here it will have been what? 5, which is what they bought, over 80, which is the previous percentage of the parent. Does that make sense? So that is then how you'll get to the new NCI. After getting to the new NCI, you compare with the old NCI. And you then say, what was the cash flow movement that resulted in the, or that formed part of this transaction? And that will then allow us to determine the change in degree of ownership. Those are the steps. Are we together? Right? It's been a while since we last saw this in ITC. So I will say, keep it at the back of your mind. Not back, put it at the top of your mind. So you need to be able to follow this step just in case. As I said before, we have been seeing quite a lot of loss of degree, loss of control as a change in degree of ownership. We've seen it so many times. Surprisingly, they don't get tired of it. So let's just, are we hoping that they do this? What are you hoping? This comes, or this change in degree of ownership, the normal loss of control.
Normal loss of control.
Then more reasons to know this, right? You don't want to be surprised when you get there. But this is it. Questions? All right. Should we move to transaction number 9? Transaction number 9 is financial instruments. They then said to us that on 1 Jan 2016, LCM acquired 600 listed debentures at their par value of 10,000 each. The debentures pay a coupon of 480 on 31 December each year until 31 December 2019, being the maturity date of the debentures. The market-related rate on the debentures was 9.092 as at 1 Jan 2016. The amortization schedule relating to the debenture is provided below. Then we see them, right? We see the 4-year amortizing out. And we see that there's what? There is a fair value of 6.3 at the end. So those numbers, we are not going to question them. We're going to assume they are correct. The loss allowance relating to the debentures was based on the following information: 12-month expected credit losses, lifetime expected credit losses. Then they confirmed on 31 December 2017, being the end of the current year, the credit risk relating to the debentures was assessed to be what? To have significantly increased, meaning we're going to use what? Lifetime. While the credit risk was assessed to be low, as at what? 31 December 2016. Which one are we going to use? The 12th month. On 31 December 2017, LCM sold 400 debentures at their par value. The accountant correctly debited bank and credited investment with the proceeds received from the disposal. So we know that this guy doesn't like to complicate his life. So he has done what is right, but ignored all these other things. The market-related interest rate was 8.7.5% per annum on 31 December 2017. 2016, 9.25. Right? What did you assume about the nature of this instrument? Did you assume that it was at amortized cost of fair value through OCI? Amortized. I love how you also love to simplify your life, which is good. That's a good exam technique. So, yeah, that paragraph I deleted was, there's the problem of deleting too many things at the same time. So whatever you've done, remember that whether you are carrying this at amortized cost or fair value through OCI mandatory, you're going to come back to the same figure, right? In terms of the gain and also the impact on P&L. So there was no alternative here. So let's first look at it as if it is at amortized, and let's look at it as if the entire question required what? Fair value. You'll see that the answer is exactly the same. But more importantly, again, the solution that you're going to get will have assumed fair value. And it will just include that paragraph that I should not have taken out with the accounting policies. So now, what is the first? Do you agree with the interest income? Do you agree with the interest income he did? Yes. There was no problem with it. We agree, right? Even took it from the right as column of the amortization table, which was the second column. And this is because we are in 2017. So I agreed with that part. It's the same thing, just on different dates. The first one is on 1 Jan 2016, then it's on 31 December 2016, and it's on 31 December 2017. So it's the same number, just on different dates. But it's on 1 Jan 2016 at the beginning. Then the other one, it's always at a point in time. It's on 31 December 2017. Yes, which is 31 December. Yes, just to confirm, we all read the information this way, right? If it says this is the number on 30 June 2017, then in brackets it writes 2016. It is usually referring to the same date the previous year. So when it just says 2016, you need to read it all together, the fact that they had said on 31 December 2017, therefore, when they say 2016, they are saying on 31 December 2016. So, in other words, the interest that will have applied throughout the entire year will have been 9.092. Then in 2017, it will have been 9.25. And then the other year, it will have been 8.75. But there wasn't much need to worry about that, because the interest always has to be based on the original amortization schedule, which in this case, it's saying 551,468, and we're agreeing with it altogether. So that's that. Number 2, do you agree with the loss allowance?
No.
Why not? It's what? It's the balance. So what did we want? So to say to the examiner you want the movement, it's a mark. So the movement, it will be the movement between what and what? 26, which is what? 2016, which is? 85, being the 12th month, right? And 2017, which is? Lifetime, and that is equals to what? 225 altogether. So the movement is how much? 140. So the loss allowance is 140, or let's call it impairment, right? And it's an expense. Do you agree? Everybody clear? Okay?
But then that means that the adjustment, because the expense is overstated right now, so then the adjustment should be at 85, which is positive.
Oh, thank you. Remember that we are adjusting, right? We are not calculating the correct thing. So since they've included 225, right? We just need to add 85. So that we are now sitting with a minus 140, right? Because we are required to adjust, not to provide the correct entries altogether. Alternatively, you could have added back the 225 and just put the 140. Yes. Yes.
I don't know why I calculated the present value of this differential.
Yes, that's our next step. We need to. We need to.
So if we need to, so why are we saying we put the interest income then?
The interest income is always based on the original amortization. It is not based on the fair value of the instrument. So the fair value of the instrument can go up and down, but the amortization will be considered based on the original amortization schedule.
That's fine, do it.
So now, what are we assuming? We are assuming that this instrument is at amortization. No, let's assume it's at fair value. So we're assuming it's at fair value. So you'll see the answer is going to be the same. So if it's at fair value, it means that it will have been fairly valued last year, right? So last year, what was the closing gross carrying amount? Last year we closed with a gross carrying amount of this instrument of what? 60,65512. What is the fair value on this date? What is the fair value of this instrument? It is the remaining cash flows of how much? What is PMT? 480. What is N? What is N? No, we're sitting at the end now. So it's only 3, right? Is there any future value? Of how much? Future value? Yes, guys. Amortization table.
But when we were calculating the
When we were calculating what?
The initial. Okay, no. They didn't give us the 6.3 million.
They did.
They gave us in a table, but let's say they didn't give us. Or
What do you say? They gave it, but let's say they didn't give us. What do you? Yes.
Is the future value 0 and when is the future value?
When the instrument amortizes to 0, the future value is 0.
Because yeah, I'm thinking because they
Yeah.
say the debentures pay a coupon of 480. So I'm thinking it's going to go down until it's 0.
Remember, with debentures and bonds, they pay the interest only, and the capital sits at the end.
Yeah, I agree. No, okay, how
You okay?
I calculate these, it was that the amortization table is not correct. So I think I read
Okay.
the question and then my thinking was,
Yes.
but it didn't tell us how much it's going to mature and the redemption amount is going to be. So I used the par amount of 6 million and then hence I'm talking about the present value.
So if you did that and use 9.092, you will have been missing the future value.
So the future value, I used the 6 million. I thought maybe it was just missing on a scenario. I don't know.
That's what I did.
Yeah, but
You get what I mean? On,
Yes.
on inception, I
Yes.
calculated the present value of the debenture. So meaning I will have said future value 6 million, payment 480, and the interest is 9%, and then N it's 4, and then I calculated the present value, which gave me 5.5788161, and then I did my amortization from the present value.
to get to the 6.
No, meaning the redemption amount at the end of period 4 will be 6, not 6.3. So
Yes.
how I read these, I thought maybe these amortizations is what the accountant have done, but then that's not how they would have done. Because I
Yes.
felt that the scenario didn't tell me how much the redemption amount is going to be. So I just used the per amount. So
Yes, and I'm saying that the amortization table was meant to make the calculations easier. And to prove it, you needed to say that the scenario is saying they acquired these debentures at their par value, meaning that that is the present value. So if you had said PV as 600 times 10,000 would be 6 million altogether, then N is going to be 4. And I is given as 9.092. Then you will have been short of the future value. And if you run the calculation, you will then end up with 6.3. Do you understand? If the table was not done.
So let's say that because I did exactly the way you did it. If that's how we answered it, would it be correct?
No, it will not be correct because the present value is given. In this case, the present value has been given. So they said that it was bought at this price, meaning that that is what they paid. And therefore, there is a present value that you need to use and you don't need to calculate another one.
And where is it given to men?
They were purchased at this price. Yes. They bought them. Remember, the present value and the cash price you pay on day one are the same. So that is why we are saying that the PV has been given because they gave us the price paid. So the only thing we don't have is the future value. So if we had attempted to calculate it, you will have ended with 6.3.
no, I understand what you mean. Because I think the way
Yes.
I read the scenario, my thing was that the future value is the 6 million. It's going to be the 6 million. That's how it's going to be redeemed with. I assume the whole table was incorrect. You get what I mean?
I hear you.
Yeah, so I get so we had it's basically saying the table is correct.
Yeah, maybe
So
this,
let's
yes.
see the scenario because I think I might be lost with my principle. Let's say this is not given.
Yes.
And then they said the redemption amount is going to be 6 million.
Yes.
We will have had to calculate the present value, right?
No, you will have now needed to calculate the I.
No, the I, we're not using the market rate that's given.
Yeah, but in that case, if you're saying that from what you will have said to me, if they've given us the redemption value, is either the I will need to change or you'll be expected to calculate it. So it will not be 9%. 9% will not be the rate that discounts 6 million back to the price of 6 million. Yes.
I know I've just made a mistake.
Yes. It will have been 12%. Yes.
And then I don't understand when you say the present value was given.
Yes. No, the purchase price is equal to the present value. You're given the purchase price. But on day one, the present value and the purchase price and the fair value are one thing.
Which is 6 listed debentures for 10,000 each.
Yes.
Normally, with other examples that we've done during the year, we had to calculate the PV.
Are you going to make me a liar? No.
Yeah, I think
I was giving you examples where, same example, we had to calculate.
I always say check for the at and with. Those are the two keywords. If it's 600 with a par value of 10,000, that's a different story altogether. But here is 600 at the par value.
Sorry, so the at and the with,
They determine whether you need to calculate something.
so if it's at, it's
What we paid. When what we paid is the fair value. And what we fair value on day one is the present value of the future cash flows. If I say with, then you need to calculate the present value.
come again. I don't understand.
Yes. Yeah, it's English. It's not a matter of principle this way. It's just being careful of the wording. Yes, always be careful of those two words.
So par basically says that your favorite.
No, par is the nominal amount. If you pay or buy at par, you bought at the nominal amount. Are we clear, guys? No, we are. We are. Check it.
It's fine. I think we'll come back to it.
Yes. I know you will not come back. You will find the correct answer. Yeah, but let's go. So we have what? PMT and this and I will then be what? What is the rate on 31 December 2016? 925. 9.25. So we get the fair value of this instrument, which is how much? Six 6041 064. So what is the fair value adjustment? The difference between the two is what? Two. Does that make sense? Same calc, sitting where? In 2017, right? Gross carrying amount is given as what? 616,136,980. Fair value is going to be PMT what? 480 N of what? 2. And then future value 6.3, right? And I is what? 8.75. There we go. Then what is the new future value? So fair value. Does someone have an answer? Six one seven four 237. Fair value difference. Did you actually need that one? No. Three seven 257. So do you agree with me that these are cumulative balances? So this is the cumulative balance as at 2016, cumulative balance as at 31 December 2017. Are we together? So now we sold these debentures. What it needs to happen in the statement of P&L? We need to do a reclassification adjustment. A reclassification adjustment requires what? So we've got OCIs of loss allowance. What is the loss allowance balance? 225. But how much needs to be reclassified? 400 out of the 600. Then we've got our fair value adjustments. Our fair value adjustment, we are saying this is cumulative up to this date, right? So that is the balance that we need to what? We need to. And then that is the reclassification adjustment.
The loss allowances, do we take the movement or just the balance at?
It's always the balance for both of them. So it's the cumulative balance. That's what the standard wants. So it has to be the cumulative up to the date that you are sailing on. Are we together? So even if it's sold during the year, they will give you the loss allowance for you to do this calc. Yes? Yeah? Are we sure of what? I'm not hearing the question. Are we sure that? Yes. No, the OCI in 2017 will be the difference between the 2448 and the 37257. That will be the movement for the year. The difference between the two. So with this technique, where you compare the amount on the amortization table and the fair value, will always give you the what? The cumulative. With this technique. You always show the 37 as the movement. No, are you sure you don't do the following? Because remember that the movement, so we are saying that the movement has to be what? The movement is that 2016 balance of what? 24448, right? Compared to the 2017 37257, if we're required to show the OCI. So this will be the movement, the difference between the two will be the movement, right? And I remember that in this case, the fair value was going down, so this one has a negative balance. And here it was a positive, so this will be a positive. So these two will be added up to give you the movement for the year. Which will be how much? What will be the movement when you add these two? Or you'll say fair value at 2016, which is 6041 064 plus the interest income minus the what? The accrued, the receipt, which is how much? So if we go to the amortization table, we are sitting with 551,468 minus 480, and this will give us a number which we'll need to compare with the fair value of 6,174,237. So what is the answer here? What is this plus this? Because remember that this was a debit and now this is a credit. So there was a movement to move it from debit to credit, which will be how much? 6,1,705. Then what is this plus this minus this? Six, one, 532. This minus this. So these are the accepted techniques to get to that number there. Which one do you prefer? You choose. It will be in the final solution.
So what is the opening balance now? And what is the 127? If we have 6,175.
This is the opening balance. This is when you go to your financials for last year, we'll find it as the closing balance.
Which amount is the opening balance for the fair value of OCI?
The opening balance sitting in statement of changes in equity.
Yes.
It is this.
The 24.
Yes.
Yes. So therefore, the 2017, 37, whatever it's going to be, profit and loss, your OCI in the statement.
The one in the statement will be 6,1 because you're closing with this.
Okay, it's
Okay. So those two techniques, depending on what you prefer, will get you to the movement in OCI. Are we together? Ringing bells? Is it coming back? Anyone say yes?
Yes.
Thank you. So choose what you prefer. Then the second last one. Dividends expense on preference shares, 250. Why did you do that? Because on 1 July 2017, LCM issued non-redeemable cumulative preference shares at their par value of 5 million. Again, at the redeemable, the pref shares have a dividend rate of 10% per annum. The dividend is payable at the discretion of the LCM's directors. The accountant classified the preference shares as a financial liability and accrued the dividends of 250, calculated as 5 million par times 10% times 6 out of 12 as an expense during the year for the year ended 31 December 2017. Do we agree with this guy? No. What are we not agreeing with? Is his calc wrong? No. What is the appropriate classification for this instrument? Equity. Is it compound or equity? What do we start with? How do we classify it? We classify based on what?
Substance.
We classify based on substance of the arrangement and the definitions of what? Financial instruments. And we also do what? We also evaluate the terms to see if they contain both a liability and an equity component. And we then continue to evaluate this what? Independently, altogether. So considering this independently, the interest income, is there any contractual obligation to pay the interest? So not the interest income. Is there any contractual obligation to pay the interest? Why do you say that? It is at the discretion of the directors, meaning that they can avoid payment if they so wish. And as a result, this is an equity element. Do you agree? Then let's talk about the capital. The capital, do the directors have a contractual obligation to pay this capital? Well, how do we know? It is non-redeemable. So therefore, the capital portion is what? It's equity. Since the liabilities, the interest is equity, and the capital is equity, the entire instrument will be equity. So if it is equity, what is wrong with taking dividends to the statement of P&L? What is wrong with that story? What is wrong? So two things are wrong. Including it there is wrong, but fundamentally, you do not accrue dividends on equity. So there is nothing that will also go to equity because you do not accrue dividends on equity instruments. Do you understand? So no accrual will be done, and therefore nothing will hit your statement of changes in equity. Otherwise, imagine how many companies will have accrued dividends to shareholders if you are allowed to accrue dividends altogether. Make sense? Then, the last one, IFRS 16 agreement. We are told on 1 Jan 2016, last year, the company entered into a 3-year lease agreement with payments over a warehouse based in Kempton Park with lease payments of 600,000 per annum, payable in arrears on 31 December, altogether. LCM incurred and paid 15,000 legal fees relating to the review of the lease agreement and also paid a non-refundable deposit to Property Inc. of 90,000, right? The lease contract included a provision that allows Property Inc. to change the lease payments to reflect changes in market-related rentals. On 31 December 2016, following a market rent review, Property Inc. advised LCM that the lease payments for the remaining 2 years of the lease will be increased to 685,000 per annum. A market rental review on 31 December 2017, however, indicated that the payment of 685 was still reflective of market-related rentals for the property, and therefore no further changes were made. The present value of the future lease payments on respective dates are summarized below. Present value of 600,000 per annum as at 1 Jan 2016 at a discount rate of 10%. Present value of lease payments of 600,000 at 31 December 2016 at a discount rate of 10%. And present value of the lease payments of 685 as at 31 December at a discount rate of 10%. Present value of lease payments of 685 as at 31 December at a discount rate of 12%. 12% is now defined as the rate that represents the interest rate implicit in the lease for the remainder of the lease term. So it's one of those where you get so many numbers and you wonder, what am I trying to do? So what is being tested here? So surprisingly, we got leases being tested, right? So who are we looking at here? Lessor or lessee? We are a lessee. So if we're a lessee, are we going to apply the general accounting provisions, or we are eligible to apply the alternative accounting? The general accounting will apply because this is neither a short-term lease nor what? No asset of, a low-value asset as the underlying asset. So that is thrown out the window. So now we are sitting with what? General provisions. General provision says we recognize what? We recognize lease liability and what? And a right of use. So did they do that? How do we know they didn't recognize the lease liability?
Because they recognized the expense of 368.
So what did we expect to see with regards to a lease liability? Interest, lease liability, only interest. Then with the right of use, how should they have measured the right of use? Day one, what should they have done? Recognize it at what? Present value, which will be how much here? You've got a couple of them. One?
On day one.
On day one.
14920.
1492000. That is what the standard tells us. It says, recognize it at the initial measurement of the lease liability. Do you agree? So we've got that. Then number two, what does it say should be included to the right of use? Initial direct cost. So do we have any initial direct cost? So we've got a lease liability of what? 1492, right? And then we've got initial direct cost of how much? 15,000. And what else do we have? Why do we need to recognize the deposit? Which principle? Any lease payment made before or at the commencement of the lease agreement. So we've got the deposit of how much? 90,000. Are we together? How much will this be? 1597000. Then what do we do with the right of use going forward? Over how many years? So we are not told about ownership or what is the useful life. So the only information we'll use is the lease term, which is 3 years. So times 2 out of 3 will give us the value at the end of the year, right? Which is how much? 1064 667. Are we all clear? Now, this changes in market-related rentals. What will it activate? So there will be a remeasurement of a lease liability. But this remeasurement, should it be done at the original discount rate or at the revised discount rate? How do we know? How do we know? How do we know? What does the standard say? Can someone just read for us?
The lessee shall remeasure the lease liability by discounting the revised lease payments if either there is a change under residual value guarantee.
Okay. Yeah, one, that's change in residual value guarantee, one.
Or there is a change in lease payments from a change in an index or a rate used.
Okay, let's continue with that. Change in the lease payments due to a rate or index used. All right? Or?
A rate to determine those payments, including, for example, change to reflect changes in market rental rates following a market rate.
There we go. So we know we were in that paragraph. Because this was a change following a what? A market rental review. So we know we are in that paragraph. Then which rate do we use to discount that? No, let's read the standard. What does it say further?
Number 43. In applying paragraph 42, a lease shall be a lease shall use unchanged discount rate.
So the unchanged discount rate, it is the original 10%. So which numbers do we need to compare therefore? Because you are not required to calculate, you are just supposed to apply that principle. Okay?
I think I'm getting lost with regards to what paragraph 43 says in refers to that.
No, paragraph 42 gives you the context on which case are you supposed to use the unchanged discount rate. Then it lists three things. When one, you do what? When there is a change in the residual value guarantee. Two, there's changes in market due to a change in the index or rate. And three, changes in lease payments due to what? To a change in, to reflect market-related rentals. Then 43 is saying that when you discount based on those scenarios that we've mentioned in 42, use the unchanged discount rate. Or to simplify, check, did the lessee have any discretion with the market rental reviews? And no, the lessee had nothing to do with that. So as a result, you could have then motivated to use the unchanged discount rate altogether. So the unchanged discount rate will require that we compare which number and which number on this table. So we're going to compare 1188775 with what?
1041,263.
With 1041,263. Do you agree? So both of them are on the same date and both of them are discounted at 10%. The only thing that is different is that the one uses the original payments and the other uses the new payments altogether. So when you discount those two, what will be the adjustment to the right of use? Lease liability remeasurement. Is it an addition or is it a subtraction? So you are coming from 1188775 compared to what? To 1041,263. So how much? 147. 512. When you add it up, what do you have? 1212. 179. Divide by what? The remaining lease term of 2. To get what? To get that as your depreciation for the year. Do we all see that? The solution you'll get first thing in the morning. So the idea, as I said, it's a past paper. I just need to put those things back into the scenario and issue you the latest one. If you are scored on a score to 1 to 5, where will you be sitting in terms of your knowledge of IFRS? So that's a 3. So please go review it, work through it. Tomorrow is tax.